Hey friends, welcome back to the channel. My name is Sanjay, and in this video I'm going to run through a few key things that I picked up from Australian Foundation Investment Company's mid-year update. Now this company has an ASX code AFI, and they do these mid-year updates and end-of-year updates twice a year, I guess, once in January, February-ish, and again around July, August-ish. So this time I thought I'd share with you a few key insights I picked up, and I think it's valuable because these are professional investors that invest in the Australian share market, and because they're listed, they have to give these kind of updates to the market. Now, I think if you're someone who invests in the Australian share market, it's handy to actually listen to what they say and pick up on some of their insights and their commentary and the way they see the share market currently operating. So I thought I'd share some of them with you that I picked up from their recent update. So here we go. Now, if you haven't heard of AFIC, let me give you a few headliners on them. They stand for Australian Foundation Investment Company. ASX code is AFI. They're about a $7 billion market cap, and they're essentially a listed investment company, which means they go out and they invest in companies already on the share market, but because they themselves are listed on the share market, they also have to report on their investments. So it's like a company on the share market investing in other companies on the share market. Now, if that does sound similar to an ETF, it is. It is an ETF, but it's not like an index fund where it tracks a predefined list of companies where just a computer's automatically picking which ones to buy and sell. Here you have actual human beings, and I think they target a portfolio of 80 to 100 companies where they essentially try and go through the balance sheets, the income statements, all the key financials, and then try and determine, is this a company that we want to actually invest in based on their key criteria. And their broad criteria is to look for high quality investment companies. They'll give good long-term returns from the point of view of both capital gains and dividend income over a long period of time. And you can see that from some of the companies that they talk about. They also have a management expense of around 0.1%, which actually puts them very close to basically an ETF like VAS, which also has an expense around 0.1% and a market cap around the $7-8 billion mark. So you're looking at very comparable things, where one is a very automatically run, computer generated, no smarts around it, they just buy the top 300 companies, and the other one, which is AFIC, is where there's actual human beings sitting in the background trying to figure out what to buy. But because it's not like a normal managed fund where they have crazy high management expenses and also they don't have performance fees, they're actually quite comparable in that sense. So because they're also a listed investment company, they have to report on their results every 6 months, and they do usually a mid-year update and an end-of-year update. And these are quite valuable, like I said at the start of the video, where you can actually get some insights into what they're thinking about, a bit of commentary on their portfolio, and some of their insights into where they think the share market is going. Personally, I like to listen to them for those reasons, and also simply because AFIC accounts for 20% of my share portfolio. And I think the next highest is only 10%. So they doubled the next biggest holding that I have in the share market. So I obviously want to pay a lot of close attention to what they're doing, what they're thinking, in case I want to drop them. No, but just because I think there's going to be some valuable insights. So I'll share them with you now. So one of the first slides they showed was their performance against the S&P 200 accumulation index. Now, the reason they showed the accumulation index is because they're trying to take into account the impact of dividends as well. Because if you just looked at the normal index, you'd only be seeing the impact of capital gains. So the accumulation index shows you dividends and capital gains, so you get a nice representation of total shareholder return as opposed to just the normal index. So you can see in the short term, the dark green bar shows that they've been outperforming the normal index. That's okay, but in the long term, you can see they're actually doing pretty much the same as the accumulation index. So it makes me wonder, I mean, it's kind of them shooting themselves in the foot a little bit, where it's like, well, why wouldn't you just buy something like BetaShares A200 product? If you're achieving pretty much the same and you get the benefit of getting 3 basis points lower management fee, that sounds like a better deal. But I guess this is where they're trying to point out in the boxes to the right, they have consistent dividend returns, and they're franked, always franked. Whereas I think when you get an ETF return or a distribution from an ETF, it's not always 100% franked. So I think that's a key call out. Now, I don't know enough about going into this detail around franked and unfranked to know if that has a material impact, like a meaningful impact. But I think that's what they're trying to call out is if you invest in AFIC, you get a consistent dividend that's always franked. Whereas if you invest in an ETF which tracks an index like A200 or VAS, these BetaShares or Vanguard products, you'll get a dividend that can tend to go up and down, but also won't always be 100% franked. I guess that's what they're trying to call out here. Now, one of the things they pointed out in this shareholder update was that they were active in the market. When everyone was still selling, they were trying to buy some things. And they gave this overview in a bit of a portfolio update. Now, I find this quite useful because you can see what they're actually investing in. Because remember, they invest in, I think, up to 100 companies, but they invest in quite a few companies. Recently, they've cut it down. But you can see what they think is good quality compared to what you might have thought was good quality. And they called out some of their major portfolio changes. Things that they purchased was Woolworths, Sydney, CSL, ASX. Now, kind of makes sense. These are considered good quality businesses that have good management teams. That's what they say. I don't know how to assess the management team, but they say that. And that they've got good balance sheets and they've got good prospects post-COVID. Woolworths makes sense. Sydney Airport, I guess it makes sense right now. It's probably taken a bit of a battering, but eventually when we have international travel start to pick up, then Sydney Airport should be back to normal business, I guess. CSL, bloods and vaccines, I mean, where else would you want to be? And ASX, yes, that's kind of meta, but what that essentially means is the company that runs the Australian Stock Exchange is listed on the Australian Stock Exchange. And for all intents and purposes, you could say they have quite a strong position in the market. I mean, where else are you making trades other than on the ASX? Every broker you deal with pretty much ends up trading on the ASX. So it's a good business to buy into. It's actually a business that I don't hear many people talk about. I guess they forget about it, but it's kind of a monopoly. So it's actually not a bad idea to invest in that company. The other thing I wanted to call out here was actually they invested in Woolworths, but they didn't make any mention of Coles. Now, they may have actually invested in Coles, but didn't call it out. But I just thought it was interesting that they did say that they invested in Woolworths, but didn't make a mention of Coles. When you actually look at their market holdings, they have something like 3% in Woolworths, but only 1.6 odd % in Coles. So they seem to think Woolworths is a better company, or it could just be that they haven't built up their position in Coles. But anyway, something to note there. Then when you look at some of their sales, South32 and an automotive group, when you look at South32, this actually, I was surprised that they had invested in South32 to start with. If you're not familiar with South32, it's actually from 2015, I think, where BHP, the big mining company, decided to get rid of a whole bunch of assets. Or not get rid of, but there were a whole bunch of mine sites, I guess, that they didn't really like and they couldn't sell, potentially. I don't know, this is not what they officially said, but I think this is what they were thinking. A whole bunch of companies that they didn't really want to hang on to, they couldn't really sell, they packaged it all up into a different company called South32 and then listed that on the share market. I'm surprised that they had a holding in South32. This is AFIC. I'm surprised they had a holding in South32 to start with. Because it's not like it doesn't have iron ore, I'm pretty sure it doesn't have copper, it doesn't have any of those exciting resources, should we say. It didn't have lithium in there. So I was surprised that they had the position in there to start with. It could have something to do with how maybe South32 was listed. Maybe it was spun out of BHP, so therefore, if you had some shares in BHP, you had some shares in South32, and then they were just kind of getting rid of it. But anyway, I was surprised they had a position in South32. Now, AFIC also called out some of the winners and losers and the things that cause a drag on their portfolio. You can see the list of winners and losers there. And they also called out, this was the interesting bit, the missed opportunities. Afterpay and FMG, the mining company. Now, Afterpay, I'll be honest, I'm probably the only person on YouTube who hasn't made a video on Afterpay who talks about personal finance and investing. Mainly because I never really followed it. Kind of came out of nowhere and then is now this like multi-billion-dollar company. Like I think it's like $20-30 billion market cap, almost the same, if not as big as Coles. And like I've never used it. I know of a few people who have used it. And the reason most people say they use this company is because they like the feeling of expensive things not feeling expensive because it's spread out over time, or they like the fact that they can buy expensive things and their partner won't notice because it's just this small consistent amount of money coming out of the bank account. So I thought that was funny. I think their commentary specifically was they weren't convinced that the price reflected the competitive advantage that they should have. They felt like a competitor could come in and eat their lunch basically very quickly. So they weren't convinced that it was a good thing to buy at the current price. I don't know what price to buy Afterpay at because it just keeps going up. So eventually I'm sure there's a good point to buy it. But anyway, that was their commentary on Afterpay. And they acknowledged that it was a missed opportunity because it's done quite well in the last 6 months and yet it hasn't been in the AFIC portfolio. Then they also talked about FMG, which is the mining company which concentrates on iron ore. And they noticed, again, that is probably a missed opportunity. They didn't have it in the portfolio, and yet it had some good price appreciation and some good dividends, actually, that being said. Now, this is one where if anyone from AFIC is watching, might I share with you some of my own insights. I would say don't buy this one though. Even though it's performed well, my concerns are it's not a good match with your investment philosophy because it's a single commodity miner. And a single commodity miner, you're essentially getting a reflection of just the price of the commodity. And what I mean by that is FMG just does iron ore. It's not like a BHP or Rio where they do multiple commodities and you have multiple sectors where BHP does oil and gas and mining. So it's kind of a balanced business. FMG just does mining and they're relying on the fact that they can get a lot of it out at a really low cost and hopefully they've got good supply or good customers to sell it out to. And the key thing about FMG is it goes up when the iron ore price goes up, but when it goes down, it's probably because the iron ore prices start to go down. And this is something that I don't think it matches AFIC's investment style. So I was surprised that they commented on it as if it was a missed opportunity, but at the same time, I hope they don't actually end up investing in it because I think it's going to be a bit too fluctuating, should we say, if that's a word, for a portfolio like AFIC. Anyway, if you're from AFIC, there you go, a bit of advice from me to you. But I think you should stick to Rio and BHP. These are good, broad-based companies worth hanging on to for a while. One other thing I picked up from mainly in the Q&A section, but it was a bit around the concerns around yield. Now, yield is essentially how much of a dividend payment is coming out from AFIC, from their portfolio. So you think about what they invest in. The idea is they invest in these companies, they collect a dividend from these companies. They use that dividend to maybe go and buy more shares in other companies or to pay it out to their shareholders, people like you and me. And the idea is they want to be able to pay out a consistent, fully franked dividend because if you're relying on AFIC for your retirement income, you'd want to know that you're getting a certain dividend coming through every year. And that's what they're trying to do, provide to you. Now, one of the concerns though is a lot of companies in Australia that currently pay a dividend return, will they still continue to pay a dividend into the next 10, 20 years? And if the answer to that is something other than yes, definitely, then you as a listed investment company need to start hunting for other dividend opportunities. Now, let me quickly throw up this graph where it's got AFIC's price performance since 92, so how their share price has been broadly going up. Their dividend yield that I believe is calculated, I guess, in real time based on the price and the last reported dividend, and their actual historical dividend amount. Now, when you see here, the key thing I'm interested in is that middle section. The dividend yield has been progressively using visual analytics, but I think it looks like it. Since the 90s to now, it's been progressively going down. Like it used to be, 4.5%, maybe 5% dividend yielding company. Now it's down around the solid 4% company. So I think this could be them saying they're a little bit worried about yield, but it's hard to point it out because if you're someone who bought all your shares in AFIC back in the 90s, then you're okay because you're getting a consistent amount of dividends coming through and it's actually gone up. You can see that in the bottom graph, it went from maybe around 5 cents to being around 10 cents a share. So that's quite good in terms of dividend returns. But if you're someone who's been progressively recently trying to buy shares in AFIC, you can see the share price is going up, but the dividends coming out have actually not been going up as well. So the yield that you're actually getting when you buy new shares in AFIC progressively over the last few years is actually lower than the yield that someone else would have gotten back in the 90s. And I guess this is them trying to say we're a little bit worried about the yield if we can continue to guarantee such a good yield going forward. Or maybe I've mixed it up. Either way, I'd round this out by saying I think there are some concerns around yield. I think they are looking for other things to invest in, and we should pay close attention to see how they pivot the portfolio for areas for yield other than, I guess, just the banks and the miners or the big miners. Now, this may link in nicely into this other section around international trading. So currently they invest in Australia and a little bit in New Zealand, and I believe it was at the last year's update, so in around July of 2020, they said that they would started an international portfolio that they're going to try and test out, like a model portfolio. And the idea here is they're just tracking a few shares to see how it goes over time, and they have a list of companies that they've probably said, if we invested in this, how would this perform over time? Sort of fake investing, but to test out if their thinking is correct. Now, it looks like from what they said, the model portfolios performed well and they like the way it's going, and they're going to think about taking it seriously, and they'll have an update on it at the end of this financial year. So around July, they'll probably say if they're going to go ahead with it. Now, I believe they said they'll commit about 1 to 1.5% of the portfolio to it. As a reference point, it's about how much they invest in like Coles and SEEK and these kind of companies. It's about $100 million, I believe, of their current portfolio size. So it's not a lot of money, but I think it'll be interesting to monitor how that goes. And if we get any insights from how they actually go about investing internationally and where they decide to go and invest internationally. Because I'd also be keen to see how they manage currency fluctuations. Because that's the question that a lot of people don't know is, should you hedge, should you not hedge? How much should you hedge if you are going to hedge? How does that all work? So I think it'll be interesting if they do decide to invest internationally, how they manage currency fluctuations and also where they decide to go. Now, I think this pivot towards an international portfolio will also be interesting to see if that's what they're doing to essentially try and increase their exposure to dividend yields from other countries or dividend payout ratios from other countries. Because when you do look at it, and this paper that came out from the Reserve Bank of Australia, the rise in dividend payments since I think it was the GFC, they did comment that Australia does have one of the highest dividend payout ratios in the world. Look at that, we're at 67% against the US at 48%. So most companies in Australia do pay out good dividends, and they pay out quite a lot compared to other companies in the world. So to move away from Australia to hunt for dividends is you being a little bit desperate. But that may not be why they're doing it. I mean, this is me, some random YouTuber commenting on it. But I think it'll be interesting to see how they talk about why they're doing what they're doing internationally, and if they can attribute more dividend returns from that investment. The other topic that came up was around their exposure to the oil and gas sector, and if they had any commentary on how they're going to pivot or deal with ESG concerns and all of that. Now, they did comment on this from the point of view, I believe they have a holding in Woodside and Origin, but they don't have a holding in Santos, even though they seem to speak very positively about Santos as a company. Their current holding is around 2% exposure to the oil and gas industry. Now, when you look at their top list, also Origin and Woodside don't seem to appear there either. So I think this will be interesting to see how they deal with that. And they did mention that they're currently conducting a review on their exposures to the oil and gas sector, and I think it'll be interesting to see what they decide to do. Because remember, oil and gas is two separate things. There's oil and then there is gas. And yes, you do find the two together when you go in to an oil field, but the idea is oil is really for transportation, and I guess there's concerns around from an environmental point of view. There's concerns around if people are going to drive their cars less, and COVID has shown that did occur, and will people recover to what they were doing before. But also with the introduction of electric vehicles and their take-up, is the oil sector a bit under threat. But then on the other side of things, there is also the gas sector. Now, gas as a product is still being used from an electricity point of view. Like a lot of Asian countries use gas, like a lot of the oil and gas, in terms of the gas that comes out of Australia, actually goes, all this stuff in the Northwest Shelf actually goes to countries like Japan, South Korea, where they use gas for actual electricity, for home electricity. So I think they will come out after their review and have some commentary probably saying, we've looked at it, we think these companies are exposed a lot to oil, so we're probably going to drop them. These companies are still doing okay in terms of gas, and they're well-run companies with great balance sheets and great management teams that effectively allocate capital well, all those kind of things, and they've decided to hang on to those companies. So I wouldn't be surprised if Woodside stays, but maybe some of these other companies get dropped off. Anyway, we'll see. But that was an interesting topic that got brought up. And it gets brought up a couple of times. I think I've heard it before in the past. Now, one of the advantages of listening to these calls is you can also ask questions. So you can either dial in on the phone, or with these new online platforms, you can ask the question online. And that's what I did. And I was curious to hear if they actually invest in dividend reinvestment plans, if they're using that to build up their positions in companies, or if they decided to just take the cash. And I put this question forward to them, and I essentially asked, do you have DRPs in your top 10 holdings? And at the time, I think the top 10 holdings included banks and maybe some of the miners. And they answered it, and this is often going to be the case, as most companies won't really give you an answer. They'll just kind of casually talk about it without really talking about it. And they basically said, we typically take cash and we look to invest that into opportunities that look good in the rest of the portfolio. So it sounds like they're not really using DRPs currently, because they probably don't, well, for whatever reason, maybe they don't think the current holdings are worth reinvesting in, and they're taking the cash out of them and putting it into other areas to invest in. And this could link nicely back up to that concern around yield that they could have right now, where right now in the Australian share market, maybe there's not that many opportunities for yield from all the high from all the, I guess, the mature, well-known businesses, and they're looking for other areas to invest their money to try and build up potential for long-term yield coming from those other companies. So that could be what they're trying to do. I don't know. But I thought that was interesting that they don't have as much DRP active currently, and they're looking to basically take cash and just put into other areas right now. So interesting to know. They're essentially saying they're not really investing more in their top 10 companies. They're happy with their holdings and they're taking their money to go somewhere else. So interesting. Now I'd like to close this out by saying I'm a big fan of AFIC. They account for 20% of my portfolio. My next biggest holding is only 10%, so they're a big chunk of my portfolio and I've hung on to them for a while. That being said though, I wouldn't buy them right now. And I'll talk about that in a future video. But if you wanted to know where I wanted to go for Australian exposure right now, I'd be going via an ETF like A200 or a VAS, something simple like that. I wouldn't touch AFIC right now, and I'll talk about that in a future video. But hopefully you found that useful. If you have any questions, let me know in the comments section below. Otherwise, I'll see you in the next video. Bye for now.